All right, let's go. All right, listen, my name is Keon Evers. I'm excited because I'm about to go over what's the difference between a whole life policy and an index universal life policy. Now, you're probably in a space right now to where you're studying for your exam or you're joining and you're trying to figure out the different IMLs. It's perfectly fine. This video is going to be a very short and simplistic way of understanding how an index universal life works and how a whole life policy works. All right, so when you are starting off in the insurance industry, if anybody's telling you that one policy is better than the other, I want you to run away, okay? There's no such thing as a policy being better than the other. There are millions of ways to structure a policy, but you just need to understand that client and exactly what's the situation that they need, okay? Or if you're looking at a policy for yourself, you're trying to figure out, okay, what policy do I want for myself? You need to understand this video. You need to understand the different types of policies and how you can expose yourself to this, right? So we're going to do it's multiple different types of policies, but we're going to first start off with the whole life policy, and then we're going to compare them to an index universal life policy, okay? Now, a traditional whole life policy and IUL is technically a whole life policy. It is designed to last you for the rest of your life. Now, when you're dealing with the whole life policy, you understand that both, they're designed to last you for your whole entire life, okay? So if you are 20 years old and you die at 80 years old, as you continue to pay that policy either monthly, quarterly, or annually, you should be in a situation where that policy will cover you at that 80 years, okay? After that 80 years. Now, typically a whole life policy, a traditional whole life policy and an IUL will both gain what we call cash value, okay? Okay? Cash value. Now, this is the biggest component in regards to a whole life policy and an IUL policy is the cash value side, okay? Now, other policies, they could last you for your whole life, or if you're dealing with a term policy, it could last you pretty much probably your whole life for a term, but you'll be in a situation where you don't gain the cash value. So both of these policies gain cash value, okay? So when you're talking about the difference in between the cash value, you're talking about the interest. Okay, if I spell interest wrong, I'm sorry. You're talking about the interest percentage gains in each policy. That would necessarily be the difference. So when you have someone that's in a situation where they're talking about infinite banking or they're talking about legacy banking, all they're necessarily talking about is you would be in a situation to where you would make a premium payment, okay? When you make your premium payment, a certain portion, it will be split just like this. Let's say that we're paying $500 a month, okay? We're paying $500 a month. A certain percentage will go towards the cash value, another percentage will go towards the death benefit, okay? Now, if you're trying to build an infinite banking policy, you want to necessarily understand that we want the lowest percentage over here to go to the death benefit, and we want the highest percentage to go towards the cash value. So as you're making those consistent payments, you might be in a situation where about $300 is going towards the cash value and $200 is going towards the death benefit, which is considered your cost of insurance. Now, when you're dealing with the whole life policy and you're dealing with an IUL, you're paying on a consistent basis. That means that $300 that's accumulating in that cash value will eventually gain interest, okay? Compound interest on a continuous basis. Now, when you're dealing with the traditional whole life policy, now you want to, don't take my actual word for this, but usually whole life policies do a low of 3%, okay? Plus whatever dividends that they pay out. So they do a low of 3%. Most of these companies, they can't say it's guaranteed, but most of the time it's guaranteed. So that means that if I accumulated over time $10,000 into this policy, and I do 3% of $10,000, I believe, is $300, okay? So that means that annually, I gain $300 on $10,000. Now, when you're dealing with the index universal life, the difference between the index universal life and a whole life is your strength of the interest is a lot stronger, okay? So you're usually looking at higher interest rates, sometimes 7%, sometimes 9%, sometimes 15%. Some policies, they do 20%. Now, the basis of an index universal life is you're looking at the indices, okay? If you know anything about the stock market has something called indices. So you might be talking about the S&P 500. If you ever heard of the S&P 500, NAS 100, NASDAQ, those are what we call indices, okay? And what happens is, in the index universal life, they state that whatever's actually in that cash value will necessarily be in a situation to where it will grow based upon the indice that you compare it with, okay? So usually, most companies deal with the S&P 500. So if you're dealing with the S&P 500, they choose those because it's more of a steady indice than most other indices. They just go up and down and up and down. The S&P 500 does an average of about 7% to about 9.5%. Some companies, their cap is 9.5%. So what happens is this: they will give you a cap. The cap means that this is the max amount of interest that you can gain in this policy for that year on whatever amount of cash value that you have, okay? So I'm gonna say it one more time. The cap is, this is the max amount of interest that you could gain in that policy for that year. Now that cap could traditionally change, okay? The company can come out and say, you know what, we want to change this 9.5 to 12.5. We want to change this 12.5 to 15%, okay? Now, if you have a policy to where that indice has no cap, you'll be in a situation to where you could gain up to however much that policy is going to pretty much, that indice is going to pretty much go to, okay? So another indice is the Credit Suisse, okay? Usually companies have a Credit Suisse at no cap. So that means that whatever's in that cash value, if that Credit Suisse does 20% gains for that year, you would gain the full 20% on whatever is in that cash value, okay? So I'm going to pretty much go over it one more time so people can pretty much understand. And I hope I'm not going too fast, because I remember when I was first trying to understand this insurance thing, it was very confusing. Everybody was shooting out things and it didn't make sense. So when you're dealing with the whole life and index universal life, in a very simplistic way, all you're talking about is a policy to where your premiums are going to be split up. A certain percentage is going to go towards the cash value, a certain percentage is going to go towards the death benefit. You might have people that say, make sure your policy is structured correctly, okay? When you're talking about structuring policy correctly, all they're talking about is making sure that you're in a situation to where in the beginning years 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 of you having your policy, a lot of money is going towards the cash value versus the death benefit. Now, most people, they say that based upon commissions, because an agent does not get paid on pretty much the cash value. They get paid on the death benefit. So for example, my agency did over $500,000 in premium, personal premiums, just with my own pen. Did over $500,000 in premiums for the death benefit. Now we put in over $1.2 million in paid premium. Well, Keon, why didn't they count the other $700,000? They didn't count the other $700,000 because we considered putting and making that policy set up correctly in place, meaning that we put that other $700,000 towards the cash value, okay? Now what happens with that cash value, you would be in a situation, I want to see if I can erase this one more time. You'd be in a situation to where whether it's a whole life or an index universal life, eventually down the line, you will qualify for something called a policy loan. Okay? Now, depending upon your company, what company you're with, they might require you to have the policy active for 10 days, sometimes 30 days, sometimes a year. Okay? 1 year period for you to be able to be in a situation where you could do a policy loan. Okay? So a policy loan is where you could be in a situation to where, let's just say over time, okay? Hypothetically speaking, let's say we're doing $500 a month. Let's say we're doing $12,000 a year, okay? Let's say we're doing $12,000 a year towards the policy. Hypothetically speaking, we can just automatically assume that $6,000 of those dollars that we put out is going strictly towards the cash value, okay? The other $6,000 went towards the death benefit, okay, to cover you for that cost of insurance. Now, when you're talking about that $6,000, we're going to focus more on this $6,000 because that is what went towards the cash value. That 6,000 is what you could do what we call a policy loan on. Now, that 6,000 is also what's going to be gaining interest. So out of 6,000, let's just say, for example, you gain 10% in that policy. Now the policy cash value is at $6,600 because it gained an extra $600 because of the interest that was gained 10% or whatever, right? So now you're at $6,600 in your cash value. What's going to happen is when they're talking about infinite banking, they're talking about all this different stuff. That's money that you put in towards the policy, okay? But you're still gaining interest on it. What's going to happen is you'll be in a situation with this $6,600, you could do a policy loan. That means that you're requesting your money out. You're requesting that $6,600 out or whatever amount that you need it for. You take that $6,600 and the suggestion is to invest into an income producing activity. So most people, what they're doing is they're taking money from the banks or they're taking money from loans to invest into an income producing activity. You have some people in a situation where it's very similar to this, that they would do a HELOC on their home, or they would take out the equity of their home to invest into an income producing activity. There's absolutely nothing wrong with that. Now, I think that the strategy goes into negative when you're in a situation where you're taking in $6,600 and you're trying to pay some bills with it, okay? We're not utilizing these policy loans to try to pay bills. We're utilizing these policy loans to do, to make more money with, okay? Or to put into some type of income producing activity. So when you take this $6,600 out, what's going to happen is, remember, you still have a death benefit. Let's just say, for example, hypothetically, your death benefit is $100,000. Okay, it's 100K. Of course, it's going to grow over time, okay, as you're continuously paying into it. But let's just say, hypothetically speaking, it's at 100K, and your cash value is at 6,600. You pull that money out, what's going to happen is that next year is still going to be accruing interest as if the money is still there. So the insurance company is not going to assume that this is necessarily a negative. They're not going to make you feel like you losing out on interest just because you pulled the money out. They're going to make you understand that, hey, listen, if the market goes up this year and you still, necessarily did a policy loan, we're going to still give you that 10% that's going to be gained that next year. There's no guarantee, hypothetical. We can't predict the market for the next year or nothing like that. I want you to understand that. But if it does that 10% that next year, you still want to understand, okay, you're going to gain another $6,000. You're going to gain another 10% on this $6,600. You pull that money out, you go invest into your income producing activities. What you want to do is, they utilize this saying called pay yourself back. Okay? They're going to say something called pay yourself back, right? And I'm talking about whole life policy or index universal. Remember I said the only differences are the interest, okay? And how soon they actually build up. And I'm gonna go into that a little bit later on. But you want to do something called pay yourself back. Now, pay yourself back means that you want to necessarily put that money back into this account. You want to put that money back into this account because what's going to happen is they're going to start charging you interest on what you owe, usually after the first or the second year. So if you do that policy loan, there's a 0% interest rate usually for the first 12 months. And after those 12 months, they'll charge you about 1 to 2% on what you owe, okay? 1 to 2% on what you owe. But if you're gaining 3% or you're gaining a 9%, right? You're necessarily just being, like, your interest is necessarily subtracting from what you've already gained, okay? Now, there's no guarantee that you're going to gain interest every single year. There's many times and many cases, especially with the index universal life, on the index universal life side, that you've been in a situation where you gain 0 interest that year because they do something called a 0 downturn potential. Both policies have a 0 downturn potential, meaning that you're not able to lose cash value in that policy, okay? Now, what some people might argue is that, well, you may not lose cash value in the policy, but the cost of insurance gets higher on the index universal, okay? Now, sometimes that is true. If it's structured in a certain way, you will necessarily be protected. If you have a certain rider, you'll be protected, or if you're actually overfunding the policy, you will be protected, okay? Now, I went over something, I said something a little bit earlier that might have confused you, might have wrote it down. I said something in regards to you being in a situation to, I'll probably have to get back to it, I kind of forgot. But let's make sure we understand this part. A whole life policy is going to last you for your whole life. Index universal life is going to last you for your whole life. The only difference is that you would necessarily be in a situation where you're getting a little bit more interest. Okay. Now with a whole life policy, we have something called a paid up additions rider. Okay. Now sometimes this is very important. Sometimes it can actually hurt the client. Now if you're in a situation to where you are 25, 35, 45, 65, up until 65, you're like in your 55s or older, I would suggest that you utilize this strategy, okay? Or younger, 65 and younger, you want to utilize this strategy called a paid up additions rider, okay? Paid up additions riders, what's going to happen is it is very similar to how you pay off a home. So that means that you're paying into your insurance policy for a certain period of time, and after that period of time, it's necessarily deemed as paid off, okay? So very similar to how you pay on a home. You pay on this home for 30 years. All right, this home is necessarily paid off. It's yours. You don't have to make any more payments. That's exactly how a whole life insurance policy could work as well. So you can be in a situation to where you could pay off a $100,000 premium in 10 years when you commit to making those payments for a certain period of time. Now it could be 10 years, it could be 2 years, 5 years, so on and so forth. Very unique style of promoting your business if you're in a situation to where you're looking at that. Because most people, they're like, listen, I don't want to pay for life insurance for the rest of my life. I want to be in a situation where I can pay it off, okay? Now, if you are in a situation where you are looking at this, what happens is this paid up additions rider is going to put a significant amount of money back towards the cash value. When I say significant amount of money, I mean the first year of you having a policy, we're looking at about 60%, okay? 60% going towards the cash value. Every year after that, you're looking at pretty much a high percent rate. So that second year, you might be looking at a 70% going towards your cash value. Third year, you might be looking at 80% going towards your cash value, so on and so forth, to where you'll be in a situation to where usually about after those 10 years, your return on whatever you actually put towards the policy is usually looking at about 90% going towards your cash value over the time frame, okay? So this is what people are literally, looking at when they're looking at their whole life policy, is that cash value builds up a lot faster. Now, when you're dealing with the index universal life policy, it's not necessarily the same. Usually with the index universal life policy, what happens is there a way I could, what happens is you'll be in a situation to where that index universal life policy builds cash value a little bit slower, okay? And when I say a little bit slower, meaning usually you don't want to borrow from this policy until 3 to 5 years down the line, okay? Now, if you choose to do more, it just depends on how you utilize this policy, you could do that. So usually 3 to 5 years down the line. Usually over here, you're looking at after the first to the second year to do your policy loan, okay? To do your policy loan. 3 to 5 years down the line, 1 to 2 years down the line for this side. Now, why would you necessarily want to do that? Remember I said over here, you're looking at about 60% going towards the cash value that first year. Over here, you're barely looking at anything going towards the cash value that first year. But the advantage on the index universal side is they will give you accumulated value. So that means that you will still be gaining interest on about 85 to 95% on whatever is going towards the policy. But you will not be able to gain access. Okay? You will not be able to gain access to the cash value just yet. Okay? So your money will still be gaining interest, but you may not be gaining access. Over here, you will be able to gain access to that cash value growth over here within the first 1 to 2 years. Over here, that access doesn't get granted until usually about 3 to 5 years down the line as it builds up. Now, index universal life policy is usually structured for people that are looking to save themselves up for retirement or be in a situation to where they're able to replace a 401k, or IRA, so on and so forth, okay? Any type of vehicle to where they're looking at just storing their money that's where they could necessarily store their money for the future. That's where they necessarily could put themselves at. Okay, a whole life policy, it could be utilized the same if you want a guaranteed rate, very, very safe. Be in a situation where you can gain that 3% on a consistent basis, and you want to be able to at least do a policy loan within that first year. You could do that. Now, here's what I want you guys to understand. There isn't a policy better than the other, and you can have as many as you would like. Okay, so I have both myself. So if anybody tells you don't do this and do that, don't listen to those people. You can have as many as you want, right? You can have a term policy, you can have a whole life policy, you can have an index universal life policy. Usually people that do these strategies, they understand what these policies come with, and they're situational. Okay, when I say situational, you might be buying an investment property and you want to cancel out interest. Okay, so that means that the money that you're actually borrowing from your policy, let's say for example, this policy is doing 3% annually, you might have to pay interest on that loan that you're getting to purchase whatever on 6% annually. So what happens is that interest necessarily cancels out. This interest cancels out this interest, so now you're only technically paying 3% interest. This is what people are doing on a consistent basis when they're talking about this whole infinite banking and stuff like that. Now, most people, they don't understand the simple form of how this stuff works, but I hope that this video helped you guys out a lot to put this in a very complete perspective on the difference between the whole life policy and the index universal life policy in one of the simplest ways. Now, on the death benefit side, okay? On the death benefit side, it is very, very similar, okay? It's very, very similar when it comes down to the death benefit, just depending upon however much percentage is going towards the cash value. Now, usually the softwares are very strategic. If you understand the softwares, if you understand illustration softwares, you're able to go out and put that information in on how you want it on the whole life policy. Usually, if you have that button with an index universal life policy, you can just go ahead and click that button. Now, when you're dealing with a IUL on the death benefit side versus dealing with the whole life on the death benefit side, most people, they would say that, oh, you don't get what's in the cash, your heirs don't get what's in the cash value, or your beneficiaries don't get what's in the cash value when it's paid out. That's not true, okay? So there's something called option A and there's something called option B when you're talking about an index universal life policy. Option B is the increasing. So that means that you'll be in a situation to where whatever you're putting towards the cash value automatically adds to the death benefit. So if my death benefit is $100,000 starting off, okay, and I put in and I got $50,000 in the cash value, now my death benefit is $150,000, not just $100,000. It grows over time. Now, with the whole life policy, it happens gradually. Now, it does not happen exactly how the index universal life happens, but it happens gradually. So you might start off at a $100,000 policy, and they might guarantee by age 65, okay, let's just say you're 25 here, they might guarantee that by age 65, your death benefit would be a $700,000, okay? But most people would say, oh, well, you don't get the cash value necessarily if you're continuously paying towards the policy on a continuous basis. I mean, you can necessarily look at how this works. Now, when you're talking about utilizing that death benefit while you are still alive, when people are talking about that, they're necessarily talking about a few things, okay? They're talking about a policy loan, okay? Or they're talking about some type of living benefits. Now, I hope I spelled that correctly. Don't know, right? They're talking about a policy loan or they're talking about living benefits. So when they're talking about a policy loan, what they're necessarily discussing is being in a situation to where if you have a death benefit of $100,000, okay, and now your death benefit is $150,000, and you do a policy loan, of $50,000, okay, you do a policy loan of $50,000, and you just never pay that money back, okay, you never put that money back into their account. That means that if you pass away, your family death benefit is $100,000, not $150,000 no more, okay? So you might think you have a $150,000 policy, but you did a policy loan on $50,000 of whatever's in your cash value. That means that you pulled the money out, okay? Living benefits, okay? Living benefits sometimes could mean that you are in a situation where you got chronic illness, okay? Critical illness, critical injury, okay? Some people got, I hope I said the word right, Alzheimer's, when you're actually forgetting things, disease, okay? So that means that if anything was accelerated death benefit, so what does this necessarily mean? It means that if anything was to happen to you, inside or outside of your body, okay? Heart attack, stroke, cancer, diabetes, you forget things. Up here, they're going to necessarily they're going to give you your death benefit while you're still alive, okay? Some companies have it, some companies don't. This is what you can use when you're talking about your death benefit, right? That 500,000, 600,000, 700,000. If you were to get, let's say for example, right, there are many cases where people were diagnosed with breast cancer and they paid out that $400,000 death benefit. Now, what am I going to do with that $400,000 while I'm still alive, right? Most people don't understand how this death insurance works, or in a sense, because they don't understand that $400,000 could be income replacement, okay? When a person is diagnosed with some type of internal or external disease, you've been in a situation where you might get fired from your job, right? You might have to step down from your job. So that means that $400,000 could pay off the home, okay? That $400,000 could pay off the home. That $400,000 could be income replacement because you're not able to work at the time. So it's very, very important that if you get approved for these riders, you have that. Now, same thing with the accelerated death benefit. That means if you were to pass away from an accident, they would necessarily give you a little bit more than what your original death benefit was. Some car accidents or anything like that, anything outside of natural causes, they will pay a little bit more on pretty much whatever your death benefit is. Now, this is very, very important to understand. And the reason why it is very, very important to understand is because you guys don't understand that these relationships are with multi-billion, trillion-dollar companies, okay? And when you're getting these policies, you don't want to just think one policy. You want to think multiple policies for multiple situations. You want to think income replacement. You want to think, okay, well, how much death benefit should I get? If you're looking at getting as much death benefit as possible, you don't want to put more money to the cash value. You want to put more money to the death benefit. So like I said, there is no right or wrong way to build this stuff out. It's only the way that works for you. And the way that works for you is you would have to tell, okay? You would have to be able to be in a situation to make this make sense. So some of you guys, I hope that this made a lot of sense, okay? I wish that somebody made a video like this for me when I was studying my exam. But I think that, this is very, very important information that a lot of people need to understand and a lot of people need to know. And I pray that this blessed you. So if you like it, go ahead and put some type of comment, subscribe. I'm gonna continue to put a lot more information. If you're studying right now, you're looking for an organization to be a part of, we're literally taking over the world in a situation where we're launching something really, really huge, really, really big, so people can understand this stuff. So the next video, I might go over how term works. And I know some of you guys are like, how young is this guy? I'm 22 years old. Yes, I'm very knowledgeable on this space. If you are young, don't let people tell you that this is an industry for you or you shouldn't be able to necessarily understand it or be able to sell it, because you do have the opportunity to do so. And starting your business out early is going to pretty much help you guys out. So I hope that this helped you pass your test, take your business to the next level, and go out here and change people's lives just like we are about to do. So if you like it, like and comment, and let's go ahead and move to the next level.